So how does a put option work? Well, in theory, it's very similar to the call option, except you can tell some of the numbers that we have, like delta and theta, are negative numbers. And why is that? Well, as a call option is giving you the right but not the obligation to buy something, a put option is giving you the right but not the obligation to sell something. Which also brings me to my next thing. You can speculate with these just like you can the call option. So in the idea that if you want to catch momentum on a stock going down, you can do so. And these are actually a little bit better of an example than what I gave with my call option. Why is that? Well, if you see the spread on these is just a couple of pennies. It's not really severe like it was on the last call option that I gave an example with, where it was at least 20 cents or 30 cents spread. But using these, in this example, I'm going to show you how to use these to actually short a stock. Now, many people will use these they will use these in the form of a Mary put or a secured put on stock that they buy. So let me give an example, just using 100 shares. Buying 100 shares right now, it would cost us about $1,550. So it's currently trading at the 1550 mark too, so that's right at the strike. So these are pretty much perfectly priced. I don't know what option isn't, but it would cost us $39 right now to reserve selling these at $15.50. So say in theory that this stock trades all the way down to $5, and it does it within this 32-day period, because these expire in 32 days. If you need to have more days ahead for expiration, it is a bit more costly, but if you took it and based it off a per day basis, it's actually cheaper. But I'm not going to get into that in this video, but that's basically what these days to expiration stand for. They're pretty much self-explanatory. But if it traded down to that $5 or even $1 mark within that 32 days, you could still sell these at the same price you bought them at, so you would have a zero loss. But the only thing that you would lose is that $39 that you put up, because like I explained in my other videos, you sacrifice the premium that you put out for an option. So how do you use these as a short though? Which you really want to profit on something going down, but you're kind of confused because it gives you the right to sell something, but what if you don't have shares and you go to exercise these? Well, you're just going to lose your premium because you have no shares to actually sell. But if you purchase, and this is actually a good opportunity right now to probably do a trade like this, it's trading at 1550, and we still feel like this is going to go down to this trend line. So our target, we want to probably cover F1411, and that's close enough to the trend line, or we could actually let it go to 14. So if we purchase our put option up here, then we must purchase physical shares at this $14.11, and then by exercising the put option, it's giving us the right to sell stock we bought in the future at a higher price. So it would let us sell it up here and we would make a profit. So to give you a better idea of this is an equity curve. Right here, this shows the point at which we would buy in at, which is close to what it's trading at right now. I believe it's 1547 or 1550. And this right here, this little line represents our break-even point. So that's currently $15.11 because we have to make back our premium on the trade, of course. Now, if this were to trade to our target, which is $14.11, we would make about $104, $105.17. As you can tell, I don't have it locked, so it is moving. But that would be about our profit, and that would be kind of our target. With doing that, we would have made our money back within this little bit of movement in the stock from, say, the 1547 all the way to 1510. Kind of pull it up on the chart, where was the 1510 at? So 1510 right there, we would pretty much have our premium made up, and then from the rest of this descend down, it would be pure profit. So that's basically how you use a put option. So another thing to love about this strategy is you can actually avoid the short interest whereas if you just shorted the stock, you would really have to worry about the momentum picking it back up, and maybe it starts trading higher against you and you have to get out of it sooner. This allows you, I think there's at least, 30 days left in these contracts, and you could be in the trade for 32 days, it looks like. And from that time, you can give it all that space it needs to trade. And most likely, I would positively feel this is going to wind up down here, but if it didn't, and it traded up against you, you would only lose that $39 that you put out for the premium. So if you haven't seen my video talking about short interest, I do have it uploaded on my page, so just type in the search bar short interest and the video should pop up, and it'll give you a mathematical figure to figure out how to actually calculate short interest. But you will probably have to find a website or a paid website that will actually give you that information on the shares shorted that for that week, or for the day, or depending on just how your trading strategy is set up. Maybe you could be looking at figures for a month, but you will actually have something to kind of base it off of. In future videos, I will cover the Greeks, which is the Delta, Gamma, Theta, and Vega. And I will probably also cover a few of these other things in this menu, such as implied volatility and so forth. But this, I just wanted to leave the video basic for this so you would have an understanding, and maybe even give you some ideas on how to use the put option. So thank you for watching.